What is this place?
Welcome to Costco.
Costco is the second largest retailer in the United States with over $220 billion in annual sales. While Walmart has more revenue and Amazon grabs more headlines, Costco quietly executes for its devoted base of 100 million customers who shop in its network of 800 warehouses across 12 countries. Costco ranks among the best performing stocks of the last 2 decades. And like every exceptional company, Costco is not successful by accident. It operates on a brilliantly disciplined flywheel that fuels its growth and deepens its competitive advantage every single year. Here's how it works. Costco's unbeatable low prices draw in shoppers, encouraging them to become paid members. Those paid members have high sales volume, making Costco an attractive partner to its vendors. Because of the volume Costco can sell, it negotiates lower prices from those suppliers, creating a win-win for everybody. And shoppers are delighted by the low prices and quality and renew their memberships year after year. This flywheel is the engine behind Costco's growth, and because of their continuous improvement in every facet, they've made themselves almost impossible to catch up with. And you and I aren't the only ones that have noticed. It's beloved by one of the best investors of all time, Warren Buffett's business partner, Charlie Munger.
Costco is a different kind of place. It's one of the most admirable capitalistic institutions in the world.
In this video, you'll learn the 7 distinct elements of Costco's strategy that make it nearly impossible to compete with. Costco has less than 4,000 SKUs. Retailers use different SKU numbers for different products based on their features like price, manufacturer, and size. Costco has less than 4,000 shopkeeping units. For comparison, a typical grocery has 40,000 SKUs. A Walmart supercenter carries over 100,000 SKUs, and a single Amazon warehouse can hold over 400,000 SKUs. This exemplifies how Costco's promise to its customer is fundamentally different than that of the majority of other retailers. It's not, hey, we have everything. Instead, it's, hey, we know you don't have the time nor the desire to research the best brand of minced garlic or snow shovels. So we went out and curated them for you and brought them here at the lowest possible price. Trust us. And this one single choice has so many ramifications for their business. For one, it's easier to stock everything when you have 20 times less product to get into the building. Every product comes in on the same standardized pallet, and no one is docking Costco points for presentation. Additionally, each Costco buyer has to manage fewer products. For comparison, check out this LinkedIn profile I found of an associate buyer who works at Target. Their category is salty snacks, which means that they're responsible for jerky, microwave popcorn, nuts, trail mix, and local chips. Meanwhile, over at Costco, here are all of the popcorn and jerky options that we could find. If you think about someone's job being distilled down to managing these products, getting into the store at a fair price in a timely manner, you can see how the Costco buyer would have the ability to be much more highly engaged, informed, and to really act as partners to their vendors. We're going to cover this in the 7th point, but it is a really powerful differentiator. Not all wholesale prices are created equal. The larger your purchase order, the more leverage you have to request a discount. Costco does over $220 billion a year. But you might be saying to yourself, Aaron, Walmart does $611 billion a year. Can't they get better prices than Costco? But remember, Walmart has 25 times as many SKUs as Costco. So Costco's revenue is concentrated across fewer products. That concentration allows Costco to get the absolute best deals from brands like Tide, Starbucks, and Adidas. More often than not, they're the supplier's biggest customer, and they have a buyer that's dedicated to just 5 SKUs, which means that buyer can get into the weeds on what actually drives the core costs of the product that they're buying. Is your product affected by certain commodities prices? Costco's going to know already when those prices go up and work with you to make sure that you can maintain profitability. But when those commodities prices fall, they'll expect their costs to fall too. They are powerful partners, but they're always oriented towards using that power to get the lowest prices possible for their members. There's a reason that the deals you find at Costco are better than anything else on the market. Conventional retailers will mark up products from wholesale as much as 100%. Even Walmart, known as a super discounter, marks up products on average 25% above wholesale. Costco refuses to mark up any of their products more than 14%. They effectively reverse engineer every deal with their vendors to ensure an 11% gross margin. They know they'll make their profit elsewhere. And this is another reason that customers don't mind that there aren't as many SKUs. They know that they're getting the best price possible. About 25% of Costco's sales come from its in-house brand, Kirkland. That equals more than $58 billion a year. That's more than Coca-Cola or Nike. In fact, it's America's largest consumer packaged goods brand. Here is how Kirkland works. Remember how Costco is most vendors' largest customer? Well, here's how Costco will use the leverage that comes from that position.
Hey, so we make up like 29% of your total revenue, right? And we're great partners, we pay on time, we're consistently easy to work with. So as we think about renewing our partnership next year, we'd like to request that you use the exact same manufacturing process that you use to produce a version of your product under the Kirkland brand. Now, with your branded stuff, you usually get a 30% gross margin. We're gonna need you to take a 15% gross margin. This is gonna allow us to continue to price Kirkland goods 15% below whatever other items they're competing with. And you're still gonna get a little bit of profit on the Kirkland branded stuff. But what this does is secure that other huge portion of your total revenue because we're deepening our partnership. Does that sound good? Great. And oh, by the way, we need to increase the quality of the Kirkland branded item by 1% relative to its competition. We actually have a few ideas.
Costco members recognize the quality of these products and buy them religiously. Check out this guy with a Kirkland tattoo. And Costco's margins on Kirkland products is actually better than on branded counterparts. It ends up being a win-win-win for the retailer, its customers, and its vendors. With 55 million members paying at least $60 annually, memberships alone fuel 75% of Costco's net income. And that membership also selects for a wealthier shopper. The average Costco shopper is a household with an annual income of $120,000. For comparison, Walmart's average household makes just $81,000, while the median household income in America is $71,000. Those wealthier customers can afford to buy more and have the space to store the bulk paper towels, snacks, and supplies that they just bought. The membership also plays on a common cognitive bias, the sunk cost fallacy. Once a member has paid to access the deals, it feels foolish to go elsewhere and pay more. And when someone pays at the beginning of a year of membership, it helps Costco's cash flow because they're effectively prepaying before they've gone shopping for anything. But since the prices are so good, Costco members renew at an astonishing 93% annually. That's crazy. That's like the monthly retention for most of the streaming services. Or said another way, most of the streaming services, Disney Plus, Hulu, lose as many people in a month as Costco does in a year. Costco's subscription model is so powerful that it was actually the inspiration behind Bezos's Amazon Prime. Every retail business has to deal with products leaving the store unpaid for. In a grocery store, some of this can be attributed to food going bad. In a convenience store, it can be attributed to someone slipping a product into their pocket and walking out. All unaccounted for merchandise is referred to as shrinkage.
You mean shrinkage?
Yes! Significant shrinkage.
And Costco's shrinkage is astonishingly small. It's just 0.15% of all sales. The industry average shrinkage for groceries is 3.1% of total revenue. But some can stay in business with shrinkage as high as 8%. The shrinkage rate for Home Depot, where none of the products go bad on the shelves, and a lot of them are bulky and hard to steal, is 1.38%. I'll say Costco's again, 0.15%. Here's why. Well-paid employees don't shoplift. Instead, you'll see them standing by the entrance and exit checking receipts. The cash register is also manned by 2 people, ensuring that everything in your cart gets scanned and paid for. But remember, Costco members are affluent and they don't want to lose access to the incredible deals, so they won't even try. And anyways, large bulk items are harder to shoplift. How are you going to stick that under your shirt? All of this equates to less shrinkage, and because all the inventory in the store gets paid for, prices can stay low. Since you've made it all the way to the 7th point, I know you can handle something a little bit more technical. It's called a negative cash conversion cycle. And it comes back to our first point, Costco is less than 4,000 SKUs. A Costco warehouse has way less variety of products compared to other major retailers, but the same amount of foot traffic every single day. The same thing that makes Costco the biggest customer for most of its vendors is what also gets more inventory flying off the shelves in a shorter period of time. In retail, this is called how quickly you turn your inventory. Target turns over its inventory 5.9 times per year. Or said another way, they'll need a fresh delivery of inventory every 61 days or so. Walmart has more SKUs, but does way more volume. They turn their inventory 8.4 times a year, or once every 43 days. Costco turns its inventory 15 times a year. That's once every 24 days. This is a big deal because Target, Walmart, and Costco all publicly state that they pay their vendors within 30 days of receiving the product. If this is true, it would mean Target and Walmart have to pay for their inventory before they've completely sold it. Walmart would take an additional 13 days to sell all the inventory that they've paid for. Target would need an additional 31 days. But Costco will sell out an entire order before it's even time to pay the vendor. It means that they don't have to finance their operations with debt, don't have to pay interest, and actually have a cash flow machine. In reality, retailers like Target and CVS and some of these other folks that don't have the same inventory turn rate end up negotiating terms with their suppliers to pay in 45, 60, 90-day intervals in order to still have a negative cash conversion cycle. It's just a much slower one. But Costco's real negative cash conversion cycle is a hidden but powerful engine for their business. It means that cash flow will never be a constraint on their growth once they've built a warehouse. Money will just pile up. So let's look at some eye-popping numbers to show how all these strategic choices compound into a retailing behemoth. Costco's per square foot sales, meaning for 1 square foot of retail space, how much revenue they bring in, is over $1,500. To compare to other large retailers, Target's is $300, Kroger is $338, and Walmart is $574. Not even close. Now, there are businesses with stronger square foot sales than Costco. Lululemon does $1,900, Tiffany's is $3,000, and Apple is $6,000. But those companies have way smaller stores. And Costco's nowhere near tapped out. They open 20 to 30 new stores each year, and once that store's established, it'll do over $200 million in annual revenue. Each warehouse requires an upfront investment of somewhere between $75 to $100 million, but in its first year can be expected to contribute $8 to $10 million of free cash flow. That's a double-digit return on capital. By now, it should be obvious, I love Costco. As a customer, I love the low prices. As an investor, I love the growth and the dividend. And as an entrepreneur, I love their obsession with serving the customer and their disciplined, strategic approach. If you learned something from this video, please drop a comment. It really helps with the algorithm. Thanks.